Let's talk about what we learned this week and what's ahead of us with Nate Peterson and Michelle Gibley joining us for a big picture discussion with the Schwab Center for Financial Research team. Michelle's Director of International Research and Nate's a Director of Derivatives Analysis. Nate, we're exactly where we started the week in the S&P 500. What is there to talk about?
Well, I mean, I think that it's kind of waiting on the Fed a little bit. I mean, the inflationary reports that came out via the CPI and the PPI, if you look at the Bloomberg probabilities and you look at what the 10-year did, even though energy, oil did play an impact in some of those headline numbers there, I think the translation by the market is largely as expected. And so it feels like we are converging a little bit, maybe in a bit of a wedge pattern here on the S&P 500 as we approach next Wednesday. And I think really it's going to be, what kind of message does the Fed want to convey to the market? Meaning, are they comfortable with the trajectory of inflation where it stands given these additional data points? I think on a more intermediate term basis, it's really that 4,600 and 4,350 there in terms of the support and resistance level on the S&P 500. And I'm a little bit scratching my head. I'm not sure why we're down so much today, but I would say maybe quadruple witching. Yields are higher on the 10-year, 4 basis points away from the cycle high. We had Adobe beat results, and they're selling off 4%. And then we had Taiwan Semi say they're delaying orders. So you put all that together into a mixing bowl, and maybe that's adding up to down 1.6% here on the NASDAQ.
All right, well said, though, with the witching. You could have said cauldron, maybe, Nate.
Oh, yes, there you go.
Missed an opportunity there. I think understated, underappreciated, and underreported probably were some of the Chinese data from this week. Michelle, tell us about the latest there, because it does seem like maybe things are starting to look up a tad.
Yeah, we're seeing a little bit of a stabilization in China. We had the monthly numbers come out last night. Retail sales and industrial production really does indicate some stabilization, and infrastructure spending could also start to pick up, which could keep that recovery going in coming months. While the stabilization is good news, it's really so far not too much to write home about. We're not expecting China to have a boom, but at the same time, we're also not expecting a bust. So we're saying that investors just may need to get used to slower growth for longer in China. Chinese and EM stocks, though, sentiment there is very low, and they may not need a boom for a rally. But a longer lasting rebound in those stocks may need signs that this rebound is sustainable, and that's likely going to need signs of healing in the property sector.
If there is some natural healing happening in their economy, does that potentially limit the lengths of stimulus or intervention that Chinese policymakers might go to in the coming months?
It's possible. They're going to have to probably continue to dole out some increased stimulus, because so far it's just very nascent. They will make sure that they hit the 5% growth target regardless of what happens.
Okay. Nate, when you think about the potential kind of wild card effects for the market generally, crude oil, of course, has been one of those as it's taken off, one of the few assets that's really got some clear direction right now. With that said, for Michelle on China, do you think that is potentially a catalyst for maybe knock-on stress in stocks here if Chinese demand helps support this WTI move?
Yeah, I do think so. I mean, look, we're trading at a forward PE of 19 on the S&P 500. The risk-free, quote-unquote, rate is around 5%. So that valuation is very hefty. So what do you need to happen in order to justify that multiple? Where you're going to need earnings growth. Well, look at oil. That is a tax on the consumer, and by extension, it's a tax on corporate profits as they take away from discretionary spend there. And then you have the dollar, which is moving up as well, which is taking away from EPS on the multinational side. So then let's look for rates, because the other way that you can get a multiple to be validated or to go or for the market to go higher is if you get that risk-free rate to come down. Well, a lot of the economic strength that we're seeing out there is justifying higher for longer. So the higher we hang around this 5% risk-free rate, it just gets tougher and tougher to validate that 19 forward PE, because you have to believe that it's heading back on its way down. Otherwise, you just look pretty expensive in the context of that.
Okay. One other thing before we say goodbye that, I love to watch the dollar. And this week, the ECB hiked rates and the dollar rallied right through it. Michelle, what do we make of that?
Yeah, I mean, the thoughts are that the ECB could be done. And there's a strong case for ending rate hikes, not just in the language that was used yesterday, but also the economic outlook is deteriorating. Lagarde said something really interesting yesterday. She said that the transmission of monetary policy so far this cycle has been faster than in previous cycles. So the implication is that additional rate hikes could threaten a hard landing there. She did, hedge her bets that they could hike again, particularly because inflation is still too high, and their forecast is that they don't hit the 2% target until the fourth quarter of 2025. But given the economic risk, we think they're likely done. And the market is likely to shift to wondering how long rates stay at these elevated levels rather than if more rate hikes are coming. And the idea that they're done did cause the euro to fall and therefore the dollar to rise.
Right. Well said. Both you guys, thank you very much for the thoughts here. Nice recap of the big events from this week and some implications for next week, too, there with the central bank divergences. Nate Peterson.